All right, now back to the RBA's shock decision to hold the cash rate, but you've heard enough from us two bullheads, so it's time to hear the reaction of someone with a few more runs on the board when it comes to economic matters, it's fair to say, and that's Judo Bank Chief Economic Advisor Warren Hogan, who's partial to making a shock cash rate call himself. G'day, Warren. Great to have you back on the Savings Tip Jar.
Thank you for having me. And yeah, a missed opportunity today. Could have gone out there with a no change call and got ahead of the market, but it didn't look that way, and that's why it was such a shock, I suppose.
Yeah, for sure. Can't wait to discuss this one. Quite pleased at how Michelle Bullock stood up in the face of all the calls. But before we get into that, do you have a savings tip for us?
Well, look, I think you got to understand savings versus wealth generation, and there's obviously a lot of access for retail players, everyday Australians to get into equities and all these other markets. But I'd just be careful. You look at bank deposits; they got an okay yield in recent times, and there's a new kid on the block called Earner, which. Disclaimer, I've been helping them for the last 5 years get up and going, but they're coming in and they're offering higher interest rates than banks because they're essentially going and investing in what institutional investors would in terms of credit and corporate bonds and this sort of thing. So have a look out for them. But of course, it's important to understand you want to protect that capital when you're saving for a home or saving for a holiday, and just be careful with putting your money in risky assets.
Yeah, nice one. I'll have to look into this one, Earner, especially, in a falling interest rate environment. If you're missing out on interest on your savings account, maybe you want to pursue certain investments. Now, onto the cash rate decision today, which was, of course, a hold. Warren, I can't remember the last time both economists and the market have been so sure of a cash rate cut, only for it to be denied. So my question to you is this the biggest shock in RBA history?
No, not by a long stretch. Where we got caught out was because if you go back a month, in the couple of weeks after the last meeting, there was quite a few economists who didn't think they were going to move in July, and the markets were pretty well priced as they always are, but it was more like 75, 80%. What got us caught out was the developments and the settling down of the Middle East, the big fall in oil prices, and then that monthly CPI, which showed pretty good progress on inflation. That sort of, from my mind, I was sort of thinking the signal from May from Governor Bullock and the board was we're sort of moving in the right direction with inflation, and we can take the cash rate back to a neutral setting. Neutral is this idea that it doesn't actually hurt or hinder the overall economy, and that is a number around 3.5. Some people think lower. So I thought it was just a sort of a strategy now to just get there, and it made sense to do it at your next opportunity. So the fact that they didn't tells us a couple of things. One is that monthly CPI needs to be largely ignored because they do. And also that, that sort of strategic perspective, while it's always important to think strategically, the idea of just getting to neutral, 3.5 quickly, was not the right way to read it. They're cautious. And I think the main message for markets and everyone else is that, yes, we may get another rate cut or two, but they're not, this idea that we're getting a whole series running through the next year, taking the cash rate under 3, that's certainly not something the RBA thinks will happen. And you shouldn't certainly be betting on it. And that's, I think, the caution tells us that.
Yeah, for sure. Now, Warren, the calls recently have been incredibly loud. And I think when the RBA moved to 8 cash rate decisions per year, both Dom and I thought that maybe the sort of media cycle will move a little bit away because it's not as frequent. Monthly was getting pretty exhausting. It seems to have just ramped up even more. There's even more hype around it. And the last 2 in particular, there's a lot of jawboning the RBA into making a cash rate decision. What do you make of that? Do you think that the RBA can stand tall despite that?
Well, they did today, to their credit, and this is what central banks are there for. I mean, there is a school of thought, not that I necessarily subscribe to it, but I think people would put under the Austrian school type label. But, why do we have central banks? Just let the money markets sort out the base interest rate and go from there. The reason you have central banks is money markets are incredibly volatile, subject to all the sort of fear and greed issues humans have. So you have a central bank there, first and foremost, to stabilise that short-term interest rate, which acts as a anchor for the whole interest rate structure, and then the pricing of everything, whether it's in the banking system or assets or what have you. So Their job is actually to stand up to the market occasionally. And I would be more of the view that the way people say that they have got to do what the market says, or them just moving with the market, is not the right way to think about it. And of course, today they had a massive green light. All economists, fully priced by market. The mob was behind them, that is the media. And they didn't do it. So that tells you that they would have had to have had some pretty strong reasons, hence my previous comment that we should read into this that they are very cautious about cutting. But I think to your point, I think we've just maybe had a miscalculation around these changes with the RBA, because I think the idea of transparency in central banking is an illusion, because the main issue is trying to think about where the economy is going to be in the future, and nobody knows that, including them. So if we've got this whole group in society, whether it be markets or the broader community, wanting guidance about where the future is, where we're headed in the future from the RBA, well, they're going to be disappointed, because the RBA doesn't know. They have good analysts, good information, but they don't know. So I think it's an illusion. And this country, where they're looking for transparency through press conferences, and the press conference is only attended by media, not people like me, economists, they, I think, are running some issues with lost in translation. They're communicating to non-experts who are then meant to communicate to the rest, short-circuiting maybe even communications with people like me or other economists who are able to sort of translate. And the problem is this country has more debt in household debt than any country in the world, and it's mostly at variable interest rates, i.e. the interest level is huge, more than any other country in the world. And then this sort of clumsy sort of conferences they do with some pretty off-the-wall questions and really tricky responses that are respectful from the governor to deal with off-the-wall questions. I'm not sure it's helping matters. So I think you raise a really important point. Unfortunately, they're committed to this, and we're probably not going to see anything change until something really bad happens.
It does seem, excuse me, a bit like today's decision was a big middle finger from Michelle Bullock and co to the the markets, economists, and just the general media political class. So I dare say some people are maybe a bit rather impressed with them, their reluctance to sort of follow the madness of the crowds at the moment. They're really sort of standing by their own views at the moment. But I wouldn't be surprised if a lot of economists are now sort of drastically readjusting their models now that this RBA is proven to be, quite strong and resilient in the face of so much pressure. So I guess, have you had to now change your near-term forecast for this financial year? I think most were expecting 2 more rate cuts this year, followed by maybe 1 or 2 next year. What are you thinking now?
Well, my response to their big shift in May, which I thought was a little bit overdone, but my response to this big shift that, inflation's sort of yesterday's story and we're now worried about, tariff-led global downturn ruining our economy, and hence the signal that we can probably get rates back to neutral, is get on with it. So I actually wrote a piece in the OFR saying cut 35 points and just get to 3.5, and then we can sort of rule a line under that and move forward. They obviously aren't listening to me, which is not their fault. But I don't think this changes much. I mean, the big thing here, getting back to this idea that we've seen these changes in the way the RBA operates in the past year or so, is that we're all sort of learning what this means, them and also us. And what we learned today is something I've actually learned many times in my 30 years, is that the RBA will do what it thinks is the right thing, no matter what the markets or the mob are saying. So that's good news, because the old model, if we remember, was essentially some of the best trained economists, brightest, smartest, best economists in the world, certainly in our country, in this institution, the guys that rose to the top of that institution, they had the job of trying to anticipate the economy and set rates. We had a group of eminent Australians appointed to provide oversight, to make sure they weren't doing anything stupid. That model worked because they had cover and they were free to sort of do it themselves. Now we've got this model where you can see with Governor Bullock, she's saying, well, we can't really come out with speeches and say anything because the board makes the decision, whereas historically it was really the RBA that made the decision. So, yeah, look, I don't think we got any wholesale model changes. I mean, there's big things shifting in our economy, which means these models aren't working, like the demographics and the technology and the geopolitics. But this particular issue around the RBA, I don't think changes the models. But what does it mean from here? Well, it's going to be interesting to see, because she was quite dovish in the statement. So And this is another thing we're seeing from the governor. She comes out or the RBA board make a decision, and then the commentary with it's the other way. So this was a hawkish hold from the sense that was expected to cut. But then the commentary in the press conference, not so much the statement, was quite dovish in the sense that she said, we are in an easing cycle. We don't think that's changed. We'll look at this in August, and basically said we're cutting in August unless something really drastic happens. So, I actually find this all confusing, and we're all learning. I think they're going to cut again in August just because they've basically said they will today, and not to do it will really add to the fury out there. But the message, and it's a message I've had for most of this year or this cycle, is rates aren't coming down that much. We're certainly not going back to where we were in the last 15 years. We're in a new world, and we are exposed as a community to inflation. That is, we have the highest household debt the world has ever seen, and it's at variable rates. So if inflation gets away from us, like it has done in many countries, including ours in the 1980s, we will pay a huge price, because when they took the cash rate to 17.5% in 1989, and Paul Keating, the then Treasurer, said, I think I heard the economy snap on that last rate hike, that was commercial property. That was the, institutional level problem. In this cycle, it will be the mortgage holder. If we've got to take the cash rate to 6-7% and break the economy because inflation is running around and out of control, it'll be devastating. It'll change this place forever. So we can't risk that. That's why I thought they should have taken out more insurance last year. But of course, right now, I think it also means they're not cutting much. Unless, of course, the economy takes a turn for the worse, whether it's Trump and tariff related or something here. But at the moment, that doesn't look like it's going to happen. So one more rate cut, that's it.
Yeah, now that's at odds with a few big bank economic peers of yours who've forecast 3 or even potentially 4 more. I think Lucy Ellis at Westpac says 2.85 is probably where it's going to sit terminally. But like you mentioned households there and how they're probably going to bear the brunt of any sort of downturn. Now, it looks like maybe the narrow path is on a pretty narrow one indeed. Household savings ratios are north of 5%, I think. Retail spending is pretty benign. Inflation looks like it's on the way down, although it doesn't look like it's been totally tamed just yet, as the RBA governor said today. What do you make of all that? Is there a narrow path, or is it still pretty rickety?
I think the RBA governor and her colleagues would probably think that concept of the narrow path has been achieved. That is, they've got inflation to this point, which is near target, and we haven't put the economy into recession. That was the whole concept. We may need to find a new narrow path in the next few years. But right now, it's a very new operating environment, and it's characterised by uncertainty, of course. But the thing that's going on in this economy is it's in recovery mode. The low point was 18 months ago. It's been a pretty patchy recovery in private demand, partly because the government's doing so much with their spending. But what's happened with inflation is the fall in the last year from inflation of 4 down to 3 has not happened because general inflation pressures declined. It's because businesses having costs still running at 5%. They just simply haven't been able to pass that on because demand's been weak, and their margins have been squeezed. So we're at a point now where you're either going to see more and more stress in the business community because their margins and profits are being hit because the costs aren't changing. And you saw that in the last national accounts. The unit labour costs, which is the appropriate measure of wages, which is the biggest cost in the economy, is running over 5%. So we either see them pass that on, inflation up, or businesses start to fold or stop investing, and that's not good for us in the long term. So we're in a tricky situation. I'd add what the uncertainty in this world is the same uncertainty that I've been talking about for 3 or 4 years now, and that is we are seeing the big forces shifting: demographics, technology, the political operating environment, whether it's democracy or geopolitics. There's a whole lot of the stuff that defines our society and economy that's changing, and normally it operates in the background. It's glacial, it's directional. All of these big forces are shifting right now, and it's making the models for economists unreliable. And of course, it's making it very difficult for forecasters, including the RBA. And that, of course, adds to caution. And what caution in central banking terms means is don't wander too far off some setting for interest rates that's broadly neutral. Have you? So, yeah, really tricky. I think having a major bank economist calling that kind of a series of rate cuts is bold, and all of them have got it. But they're going to, economists in general, and I've done that role in a bank for 20 years, The main thing they don't want to do is really stuff up. And when you're uncertain, how do you avoid a stuff up? You go and just join the pack, the herd, the crowd, because it's fine to be wrong if you're wrong with everyone else. And if you're right as an outlier, a hero, you may get some reward, but most of them are conservative people. So they're hugging consensus. And of course, it becomes self-fulfilling around market pricing. And market pricing has been inaccurate for over 2 years now for reasons I won't explain, but not enough rate hikes priced in, too many rate cuts priced in, constantly happening. Economists move to that as a safe place. Bob's your uncle. That's what we've been getting, and that's where those forecasts come from. And that's unfortunately, hopefully not too disappointing for the broader community. That's about as technical as it gets.
Yeah, it sounds like this month was just a good month to be an economic contrarian, which is usually yourself, Warren, but you missed out this time around, unfortunately, because you went with the crowd for a rate cut. But as always, great having you on the Savings Tip Jar podcast, hearing your thoughts. Thanks very much for your time, Warren.
Fantastic. Thanks for having me on, and all the best to everyone.
Thanks, Warren. As they say in the jungle, you don't need to be the fastest runner, just don't be the slowest.